So this is the question. How do you identify auction and absorption on the footprint? And then how do you execute as a trade strategy? And it's the first part of the question I can definitely answer for you, and I can show you those principles, and that's precisely what I'm going to do. The execution part, okay, I'm going to show you how I execute it and the reasons why I execute it. But at the end of the day, that's up to you. The strategy you apply to the principle is dependent on you. Okay, it's dependent on your risk parameters, depending on the size you're using, depending on the market you're trading, depending on the approach you adopt, depending on all these variables. So it doesn't matter how I execute it, it matters how you execute. All right, now this is the principles, guys. So if ever you want to know, or you ask someone, or someone asks you, what defines this as absorption and auctioning, these are the 5 principles you've got to be able to answer. Okay, if you cannot answer these 5 principles, well, what you have then is you've got an idea of what auction and absorption might be, but you do not have a firm approach as to how you identify it. Okay, so the reason we have these principles is very simple. It's called benchmarking. Okay, in other words, I can take any example that you send to me via email, I can benchmark it against these 5 questions, and I can tell you straight away, in my opinion, based on my principles, this is or this isn't absorption and auction. Okay, there's no debating of it. It comes down to the principles. Right? The same applies to you guys. As you build your strategies, you've got to build these principles around how, obviously, your strategy becomes identifiable or not. All right, so the first principle is passive versus aggressive. Now, the best way to explain this, I'm going to do some annotations, but I'm also going to bring up a chart in the next slide, and I can explain it that way. But what we're looking at here, passive versus aggressive, is the switch in price response. Okay, so passive merely means that as we approach an area of support, right, there's passive bids sitting in the market. In other words, there's limit orders in the market on the bid. Okay, so what happens is you get a lot of selling, right? Because there's a lot of passive bids, a high amount of passive bids, you also get a very high delta. Okay, now once that passive execution is filled, what happens is then we get an aggressive reversal. Why? Okay, the basic understanding of option and exhaustioning is it's a market that's moving sideways. Okay, so we're having trade facilitated on both sides. Now, the reason trade is being facilitated on both sides is because the market deems this area as support and this area as resistance. In other words, the market comes down to this point, it finds responsive buyers, and eventually the sellers back off, they start to take profits or unwind, and we get a reversal. Okay, the same thing happens. We get buyers initiating towards resistance. Once they find that passive selling, they step out, they stop buying it, and the market then rolls back down. Okay, so that's what we mean by passive versus aggressive. Passive means I'm passively sitting on the bid absorbing. Aggressive means I'm aggressively lifting the offers as price goes higher. Okay, that's the major distinction between the two. Now, it's important to identify where that is located. Okay, what we shouldn't be seeing is we shouldn't be seeing very aggressive price action down towards the lows and the highs. Okay, it should be passive at the low and the high, and should be aggressive as price turns back up towards the opposite side. Okay, the second then is responsive versus initiative. All right, very similar to passive and aggressive. The difference here is that towards the lower bound, the support area, we have got a response from buyers. Okay, so what that typically looks like is we've got a high amount of delta being absorbed on the lows. Okay, so they're responding to the lower price. Right? Once they've responded, they then initiate price to the upside. So what you should see is something similar to this. Okay, price goes up to resistance, and then we get two-way trade. And then price initiates in the opposite way, we get two-way trade. Price bids up, we get two-way trade. Price offers, we get two-way trade. And that's the nature of responsive and initiative. Now, again, it's not always as straightforward as a pattern like that, guys. But the concept, the understanding is that in this area, we have responsive reaction from the sellers, and then the sellers initiate. In this area, we have responsive action from the buyers, and then we initiate in the opposite direction. Okay, that's effectively the process of absorption. There's absorption or responsive price behavior taking place at the support and resistance. Okay, and then we look at things like volume, delta, and price response. And these are paramount. These are literally the underlying principles that define, is this auction and absorptioning or not. Okay, now again, I'm going to use the same example. What we typically see in terms of volume is we see a high amount of volume or a high amount of activity at the extreme points. Okay, so you should be seeing the highest volume in terms of the structure at the extreme points, okay, not in between. Why? Because what's happening is as market goes bid, there is no one selling it until we get to resistance. When we get to resistance, there's buying and selling, and that's what creates the increased activity and increased volume. When we start to offer down, there's no bids, no one is buying it. Why? Because support is lower down. So there's a lot less volume transacting relative to when we approach that support area. Okay, again, delta as well. We should see strong corresponding delta, very strong buy-side delta at the high. Note, positive deltas at the highs, very negative deltas at the lows. Why? Because we're seeing buyers that are buying offers, but sellers that are responding. So the process of responsive and initiative is as we approach resistance, we see buyers that are lifting offers, but the sellers are providing more liquidity than the buyers combined. That's why we see a positive delta at the high and a negative delta at the low. Okay, and then price response, and this is key. You've always got to see price response off of these highs and lows. In other words, if we get initiative, we come into support and we get initiative off of that low, we should see the price respond as well. Okay, so once that price starts to respond to the upside, that's the price response we're looking for, and that's ultimately the process of initiation that's begun. Okay, when we're seeing absorptioning, the price response is more sideways. Okay, so we see a lot more two-way trade, right? That's the responsive price reaction. Once that responsive price reaction is done and we initiate again, then we start to see price responding in the opposite direction. Okay, those are the underlying principles. Now, again, I know I've gone over those in great simplicity, but those are the principles you've got to be interpreting and understanding with regards to auction and absorptioning. Okay, so the example we're going to use is the S&P 500. For good reason. We've entered a process of absorption and auctioning now. Now, this is the daily chart. This is what the daily looks like. And I want to show you this chart for two reasons. One, note what's happening in the volume. Okay, so we've got a significant amount of volume. Now, a misconception is that auctioning and absorptioning is just when a market goes sideways. No, it's not. Okay, auction and exauctioning is a very, very big time frame play. In other words, we've got big time frame participants entering at resistance, entering at support. Therefore, the volume has to be relatively high. Okay, if the volume was something like this, where it's well below the average, straight away I would look at it and say, I don't know if that's necessary absorption and auctioning, rather just a little bit of consolidation trade. Remember, consolidation is low volume where the market is just trading between 2 points. Absorption and auctioning is where the market's facilitating trade, i.e. we have initiative of lows, initiative of highs. Okay, so that's what we're looking at, and obviously what we would expect to see is a range that starts to contract. Okay, we can see that the moving average is very, very steep towards the downside. We've gone from an average of 50 to 70 handle ranges all the way down to 25 to 30. So contraction in the range, and those are very, very important principles of the footprint. Of auction and absorptioning. Okay, so this is our first example. Now, I'm going to go through the chart with you in a minute, but this is in essence what we're looking at. So this is the start. This is the approach of 2676, which is that point there. Okay, so we're going to look at these 4 points. That point there, that point there, that point there, and that point there. We're going to look at those 4 points, look at the response of the delta, the volume, all these things we've just discussed as our key principles. Okay, so let's go into it and have a look. Now, this is the first one as we approach those 77s. This is the first time we made a top. First thing to note, notice the volatility coming into this, okay? Do bear in mind, guys, when I look at absorption and auctioning, I look at it first on a 60-minute chart, okay? It's a big time frame play. So I first look at it on a 60-minute footprint, and then I narrow it down to a 5-minute footprint, okay? You can see this on either time frame. The principles remain the same. All right, so the reason I like to look on a 60-minute time frame is it just puts me in that bigger time frame perspective. Now, what we can see is the market approaches this high called 2676. At this point, we don't know that it's resistance. We know nothing about it. We just know that the market approaches this price point. Okay, so we have a very full-bodied, aggressive 60-minute rotation, substantially high volume, very strong delta. Market then continues. Now notice straight away what happens between the volatility between candle 1 and candle 2. Contraction. Okay, so that's the process of now sellers starting to provide liquidity, and we start to get the process of responsive price action. Okay, the sellers are responding to higher price. Note the next candle is pretty much an inside candle, so a continuation of that responsive price behavior. Do note the deltas. Okay, so we saw a positive delta coming in, and we're now starting to steadily see a negative delta in. But note the coloring. Okay, so not aggressive selling, not yet. Remember, we don't want to see initiative at the highs. We want to see responsive first, and then see the process of initiative. That's pretty much exactly what we get. We get the responsive for almost 2.5 hours, and then we start to see a little bit of initiative. Market comes back a second time. Note the dark coloring. Note the buying. Okay, all that buying, all that volume, 227,000 contracts. How does price respond? Okay, barely. Right, if we compared to the previous day, we had 220,000 contracts up here. Price responded almost 20 handles. Next day, similar price action, similar delta, similar amount of buying, but price can only respond by 6 or 7 handles. Note the differentiation. And the only difference is that sellers are now continually responding to those higher prices. All right, market then drifts off, and we see this booze drop all the way back down to 26.12. Okay, so a good 60-70 handle rotation. Now let's continue on this theme, and let's get the actual example up. So market sells off, we can see continuation, and we come to this 26.16. Now note, very aggressive price action. Okay, look at it, so I'll zoom it out. Very much one time framing. Red price, red price, red price, red price. Delta negative, negative, negative. So lots of selling. That's the initiative now. Okay, remember what I said. Responsive at the high. Sellers initiate to the downside until what? Until they find those responsive buyers. Until they find it, price is going to keep moving lower. All of a sudden we get a response. Right? We get a response. Note the price change. From 26.25 all the way down to 16s, but reverses quite aggressively. Okay, again, notice the delta, flat. Very next candle, what do we see? Bit of responsive from the buying. Very next candle, the buyers start to initiate off of that low. Okay, so again, in the first example, we saw a lot more initiative. Okay, a lot more responsive price behavior from the sellers. Now, why would that be? Well, it's very simple. The trend is to the upside. Okay, it takes, there's an expression that it takes a big ship time to turn around. Equally, it takes a trend a little bit more time to turn around. Right? Now, because the trend's to the upside, you're going to see more responsive on the upside versus the downside. Why? Simply because buyers are trying to get on more aggressively than sellers are trying to short the trend. Okay, so we get that response. Market navigates away, comes back a second time. What do we see? Substantial volume, guys. A real aggressive amount of volume, but price, again, responds to the upside. So we get rejection. So more responsive behavior from the buyers. Not once, but twice. Note the delta. Okay, a very aggressive selling, but the buyers are providing that liquidity, and that's why price can't go down. Right? Again, we see more passive behavior, more responsive from the buyers, and eventually the market starts to navigate higher. Okay, so then the market goes back up again, and we come all the way back up to that previous price point of 26.77. Again, notice what happens. Right? Market goes bid up. See what happens now in terms of the range. Okay, all of a sudden now we're seeing responsive price behavior again. Right? A lot of overlap, a lot of two-way trade, a lot of volume, a lot of mixed delta, buying, selling, buying, selling, buying, selling. Okay, and the market then auctions low. And again, notice how easily the market moves from high to low, but how difficult it is at the extreme points. Okay, and that's an important thing to note, because when I show you the trade execution, I'm going to show you that the opportunity is not in preempting or just randomly fading. Okay, why? Because otherwise you'd have to sit for 4 or 5 hours. The opportunity is once we get that initiative, i.e., once we get that selling coming in, then initiate to the, then look to be aggressive, because that's when you're going to get your best bang for your buck. Okay, market comes down to that lower bound again, 26.16. Notice the amount of two-way trade. Okay, so that's the crux of it, guys. In essence, all we're seeing is a process of, absorption at the lows, or responsive price behavior. Once we start to turn back, the market facilitates trade very easily in the opposite direction. Okay, so straight away, in terms of the execution, all we're looking for is once we break these defined ranges. Okay, obviously you can be preemptive. You can, take the risk of selling at these price points, and you should consider it. Okay, but just be aware that when you're trading it at these price points, one, it could take a long time to start to offer in the opposite direction. So time's an important constraint. The other thing is obviously defining your risk. Okay, where do you place your stop? You can't just simply place it above the previous high. Right? That does not define when the breakout is likely to occur. So make sure you interpret that, however you do, but be aware that you can be preemptive, but more importantly, or better, is to wait for that initiative leg. So wait for that negative delta to come in, as well as the volume, and then look for short side trades. Okay. Equally, if we go back to the first example, now note again, a lot of people say, "Oh, so did I short it here?" No. Okay, the simple answer is no. But I am aware of that price point 26.76, and once we come back to it, I'm then looking for short side trades. All right. If we come to the downside, again, what we can see is we see the market come down, quite aggressive, responsive price behavior. Once we take out, obviously, that previous extreme, we can look to start buying in the opposite direction. Okay, so it's very much a case of be aware that at the lower bound and the upper bound, you're going to see price response. You're going to see responsive price behavior. Once we start to see the price responding in the direction we expect, then we start to buy it. In other words, this candle's not where we buy it, simply because we want to first see responsive price action. Once the price responds, i.e. now we can see prices starting to move higher, then we start to trade towards the opposite extreme. Okay, similar in this example, so we can see there's responsive price behavior. Once we take out this extreme, then we can start to look to buy, because now price is responding and corresponding to our trade idea.